Go. You're very welcome.
Thanks, Peter. Thank you. The Indie List webinars, I say, they're always interesting and entertaining, so I'm under a little bit of pressure here. This morning we're looking at tax, so it's definitely going to be interesting for one of us. I'll try and make it entertaining, but it is tax, and I am an accountant, and I am wearing a beige jumper, so the odds are stacked against us. As Peter mentioned, in my career as an accountant, I've worked with all types of business owners, but the passion where I get the most joy is working with people like you, because I see the difference, good tax planning and good advice, how it can change the finances of regular hardworking people. And I've said before, a human smile is worth more and lasts longer than any fees earned. I'll still take the check. The smiles don't pay the rent, but it's great to see them coming. So might just kick off then. I'm going to spend 2 minutes talking about why it might be better to be a limited company for those online who may be still wondering about, should I stay as a sole trader? Should I move to a limited company? What are the pros and cons? We touch on that a little bit. Being a sole trader is perfectly fine, but it is more tax efficient to operate as a limited company. Then we'll jump into the expenses, how you can reduce your tax bill. As I'm chatting, throw your questions into the chat box or the question box, and I'll answer as many of these as we can after we do the expenses section and before we move into how to build wealth for the future, which is the last piece. And all going well, we'll have you out of here by about 2 o'clock, 2:05. I might use the word contractor or freelancer or self-employed as I move through the slides. They're all interchangeable. They all mean the same thing. It's all looking at self-employed professionals. In terms of why you might operate through a limited company, the reasons are many, but 3 or 4 key reasons. The first one really is to do with tax. As a sole trader, you pay income tax. So I'm just going to assume everybody is earning, and I know some people new mightn't be, but once you hit the €42,000 bracket, you move into the higher rate of tax. So when you add USC and PRSI, you're essentially on a 52% tax rate. And as a sole trader, you pay income tax on 52% of the profit for the year, even if you haven't yet spent that money, even if you haven't yet collected that money from your client. Whereas a company, you only pay income tax on what the company pays you in salary. So it can be useful from that point of view. Many expenses and tax saving opportunities, which you're going to see as we move through the slides, are not available to sole traders. They can only be available if you're in a company. You'll all have heard the reasons that limited companies give you limited liability, and everyone says, well, nothing's ever going to happen to me. But if that's the case, then why do we have car insurance? Why do we have house insurance? Why do we have health insurance? You don't buy a brand new Mercedes and opt for third-party fire and theft. So, the limited company is actually a way to protect your personal assets by keeping your business separate to yourself. And the other big one, because it has such a big tax implication, is around pensions. And as a sole trader, you're restricted by the amount you can put into your pension based on your age and your earnings. I am going to look at that in a little bit more detail in a few minutes. But for those of you operating as a sole trader, is it okay? Yes, of course it is. Do we look after the accounts of sole traders? Yes, of course we do. You get the same great service. But I just know I can save more tax when you're in a limited company. By the way, take down this number or pop it into your phone. If you don't have a pen handy, it's 01-611-0707. 01-611-0707. That's our number here. Kieran and Ian are colleagues of mine. And if you're curious about how we work, then give the lads a call. I always say we're better than accountants because we do everything you expect from an accountant, but we also have a mortgage business that specializes in mortgages for the self-employed. We call that Mortgage Navigators. We also have Contracting Plus Financial, which is a free service looking at your pensions. We also give you insurances, so you don't need to. I'm going to mention about PI and employer's liability and public liability. When you're with us, you get all those. You don't need to go out and buy those separately. We give you software so you can cancel that online accounting subscription, and we're just generally nice people as well. So, that's the sales pitch over. For those of you thinking about expenses, if you've been working for a while, you're going to know some of these, but they're really for the newer people online. I want to cover the basics, and they serve as a good reminder to us. I want to thank Mary, my colleague, for putting the slides together for me. But look at this guy. Is he suitably dressed? I think not. Nobody wears a tie these days anymore. Working from home does remain popular though, and kitting out a home office is a tax-deductible expense. What's not on the slide are things like gas and electricity and broadband. They're also tax-deductible. There's no fixed percentage that revenue approve, as Everyone's circumstances are different. If you live alone in a 2-bed apartment and you're using one of those rooms as your office, then there's a good argument for saying, hey, like 50% of my light and heat and my broadband is business related. But if you live in a 4-bed house and you've got a spouse and 3 kids and a dog running around and your home office is a corner of the kitchen, then you're not going to be able to justify 50% of your utility bills. It is case by case. But to figure out how much to claim as a tax deductible expense, you take all of your bills for the year. You take the percentage relating to the area of the home that is work related. So whether it's 10%, 15%, 30%, you just need to justify that it's a fair percentage. And then that's the percentage you put in against your expenses at the end of the year. Now, if you're a limited company, then you have the option of paying yourself the €3.20 a day working from home allowance. That might be better for you in terms of cash, but also a lot less administration. Sole traders, though, cannot pay themselves the €3.20 a day. Then we have things like coffees, transport, lunches, newspapers. Personal expenses will vary from person to person. Over the years, I've had clients ask, what can I spend my money on to reduce my tax bill? You know, I'm always a little bit confused by that question. I've said it here before. I mean, if you've got, let's say, €10,000 in profit, that means you'll pay €5,000 in tax if we just assume the 52% tax band. And when you pay that, you'll have €5,000 left to spend, right? Now, for the purposes of the story, I'm ignoring pensions and lots of other things, but if you want to go and spend, say, I don't know, $2,000 on something you don't really need, but it gets your tax bill down to $4,000, then you're going, great, my tax bill's only $4,000. But yeah, but also you spent $2,000 on something you didn't really need, and now rather than having $5,000 in your hand, you've got $4,000. And how's that smart? I understand the logic, but everyone thinks about paying less tax, and that's a great way to think. But you also have to think about, why am I spending money on this? You know, do I really need it? Being smart about claiming expenses to reduce your tax bill makes sense, but only spend the money you need to spend. It's not about how much you earn, it's about how much you keep that matters. Again, as I'm going through this, I know I'm moving quite fast because some of this people will have seen before, and I don't want to bore everyone to death. So if you have questions, stick them in the chat box and we'll come to those in a little while. The small benefit scheme is the easiest way, I'd say, to save tax, a small amount of tax. Again, only available if you operate through a limited company. It's simple. The company buys a voucher for €1,000 and it gives it to you to spend. So the voucher could be like a Me To You card, like you see there, or it could be a voucher for an airline if you're going on holidays, or it could be a voucher for a supermarket if you want to do your weekly shopping. There's also MasterCard style vouchers you can use, spend the money as and when you need it. But it's essentially €1,000 into your hand every year with no tax. So you're saving €520 if you're at the higher rate of tax. Now, if your spouse or your partner or your child also work through the company, then everyone can be given a voucher. I will look at family employment again in a couple of slides, but it's just a reminder that it's really, really easy. Buy a voucher for €1,000 and it's tax-free. Can you buy more than one voucher? Yes, you can, but you can't buy more than 2. So it's any 2 vouchers and it's a maximum of €1,000. So if you buy a voucher for €300, then the next voucher should be €700, because if you don't get to the 1,000, if your first 2 vouchers don't get to the €1,000, you lose out, because it's a maximum of €1,000 and or 2 vouchers with the €1,000 limit. The Bike to Work scheme is also well known and often forgotten about. And a lot more people are upgrading their bike or renewing their bike. It doesn't apply to electric scooters, but it does apply to electric bikes. If you're buying a bike or bike equipment, essentially it's tax-free when you buy it through your company. Again, sorry, not available for sole traders. It's €1,250 for regular bikes, $1,500 for e-bikes, and $3,000 for cargo bikes. You can also buy a bike that's below that threshold and use the balance to buy some of the paraphernalia to get to the upper limit. Or if you're looking at a bike that's more expensive than that, you get up to the limit you see on screen, tax-free, and then there's no tax relief on everything above that. Personally, I find the local bike stores very accommodating with the Bike to Work scheme. Look, it's always good to buy local, buy Irish. Company cars now. Should I buy a company car is probably one of the most asked questions. The clues in the name. Tax reliefs aren't available to sole traders, but a lot of sole traders do use their car for business purposes. So if you do that, what you do is you add up all the running costs of the car, the tax, the insurance, the fuel, the repairs, tires, everything. And then you also track your mileage from from the start of the year to the end of the year. What's business and what's personal? And the percentage of the business mileage. So if you do 1,000 miles in the year and 250 of those were business miles, then essentially 25% of all the running costs of your car can be used against your business to reduce your tax bill. Regardless of whether or not you operate as a sole trader or through a limited company, travel to and from your normal place of work is not business travel, and the revenue are very, very strict on that. We now have to record, everyone has to record the amount of mileage claimed by every individual on a monthly basis and send it into the revenue commissioner. So Big Brother is watching. Like everything, whether or not the company car is the right choice for you depends on personal circumstances. Do you need a car? Do you need a new car? How much mileage are you going to do? How much of that is going to be business mileage? Is electric something you can live with? Because really that's where the tax benefits are. There are super deals to be had on electric cars and secondhand electric cars at the moment. So it's not a bad shout if you need a car and if electric works for you, because hybrids are treated as just normal fuel cars. It's not a big exercise for your accountant to do. We do it all the time, and we have a good blog on buying a company car. So contractingplus.com, and have a look for the Insights tab at the top of the page. And there's a blog on buying a company car there. So more detailed information for you to get your teeth into. If you can't find it, give us a shout and we'll send you on the link. It's definitely there. Next then is employing a family member. So this again is a popular question. The reality is, can it be done? Yes, it can, but it must stack up. So as a single person or as an individual, you can earn 42,000 euro before you move up to the higher tax band. Those married are in a civil partnership with one income between them, that 42 goes up to 51,000 before moving to the higher tax band. So let's say, for example, you're earning 80,000 euros a year and your spouse or your civil partner doesn't work and they're doing some admin work for you. Now, you can earn 51,000 together at the 20% tax rate, but you're actually earning 80,000, so the difference is 29,000 euro. Can you pay them 29,000 euros so you get all of your income at 20%? I'm going to say no. I'm not sure that paying a part-time administrator 29,000 euros a year stacks up economically. Commercially, it might be the best damn administrator in the world, but part-time work doesn't cost 29 grand on the open market. Pay them a figure that makes sense commercially. Pay them a figure that when the revenue start asking questions, you can fully stand behind it. For example, if you were to hire an outsourced receptionist firm or PA firm, or you might end up paying, 10, 12,000 euros a year. So if your spouse or your kid is doing this work for you, why not pay them? Keeps the money you earn in the family pot. And if they've no other earnings, then they'll pay little or no tax on earnings of up to about 13,000 euro. So the figure on screen there, 13,000 euros, your 6,760 is the tax saving. I mean, that's a big chunk of money for shopping, for college fees, or whatever else your family spends its money on each year. So well worth doing, but it's got to stack up. It's got to stack up. I keep saying that because, if revenue come along and they see you doing something that it looks like you're trying to evade tax, that's not.
Jimmy, sorry, I missed the bit about the 14 years and the 16 years. Just go over that again.
So it's 14 years, 16 years. So 14 years if it's a direct relation. So, your son or daughter, and then 16 years would be if it's anybody else. So there's certain rules around employing children as well, that they can't work for more than X amount of hours in a row. I don't know what they are off the top of my head, but a quick Google search will give you that information.
Okay.
14 years if it's family employment, and you have to be older if the person is related to you.
It's fine. Thank you.
Citizens Information actually has some good information around that, around the bans and what the hours and things like that. And the last thing I'm going to look at, and then I'm going to do questions before we move into building wealth for the future, is, and those of you who've been on this before will know this, on the next slide, I'm going to show you what you should be filling in on your tax return to give you the best chance of saving tax. So if this is the first time you've seen this, get your phone out now or get ready to take a screenshot. Here we go. That's what you should fill out. Nothing you should fill out on your own tax return. It's a complicated form. You shouldn't be doing your tax return yourself. You don't service your own car, I hope. You don't build your own extensions. You don't service your gas boiler. I always argue, and yes, I'm an accountant, so of course I'd argue this, but your tax return is no different. Invest in a good accountant because that's what it is. It is an investment. It's not just about how much tax am I going to pay this year or next year. You know, you're looking at tax structure, you're building up a relationship, you're getting tax advice that's not just about today, because actually, yes, something might save you a few quid today, but that might have negative consequences in 5 or 10 or 20 years' time. So it's always dangerous to ask a question in isolation. And we get that a lot. A client might say, can I do this? And I go, it's possible that can be done. Why do you want to do it? And sometimes they're asking the wrong question. So that's really, really important. Those of you online who are already with Contracting Plus know your tax return is included in the service fee. So you have nothing to worry about there. We have a super tax team here waiting to help and answer your questions. Okay, so the questions, let me just jump in. I might just stop sharing for a second, if I can do that. Yeah. And the chat. I don't see a question box. Maybe is there a question box there? Am I just not seeing that?
Yeah, there's one, Jimmy. It should be under chat. What'll I just see now? It's under more. Can you see more there on your bottom of your screen?
Oh yes.
And under there's chat.
There we go.
I just, when you were talking about the car Jimmy, and you said it's a question whether you need a car or not. So if people are hiring one of those drive as you go cars for business purposes, can you claim that as an expense?
Yeah, I mean, if it's a business, you'd still have to record the trip, Peter. You'd have to say where you were going from and where you were going to. And the thing is, if you're on, let's say, doing a project out in, I don't know, client X for a month, and you're going out and back every day for a month, then no, because that's getting you to and from your normal place of business.
But is it your normal place of business as a freelancer? I mean, if your normal place of business is at home, can you argue that with revenue?
You can argue and you lose because we've had that before. Just because your business is registered, it is a tricky one. I mean, if people feel that they have a case, we always say, look, let's have a look at you. There's no kind of one box, and you either fit in the box or you don't fit in the box. There is a little bit of leeway, but it's small. I have the chat open, but I don't see the questions.
There's just one question there from Olive. Olive, do you want to ask that question? Can you audit companies also?
Yeah. Sorry, Jimmy. Can you hear me there? I've unmuted.
Yes,
I think.
Olive.
I'm just wondering, can you audit companies?
We don't do the audit. We have an accountancy and audit firm we work very closely with when a company might need that done at the end of the year. So sometimes what happens is we'll take on new clients and they've either missed a deadline, a filing deadline, something like that, and they're required to have an audit. We can still get everything up to speed, and we've a firm we work very closely with who then does the audit for us.
Okay, brilliant.
So yeah.
Thanks, Jimmy.
Great question in there from Oisin. Jimmy, do you want to have a look at that?
So if you're a sole trader, you have to count everything that comes in as income. If you're a company, do you have to spend everything in your bank account by the end of the year, or are you tax on the profits of corporation tax? Yeah, really good question. I'm going to touch on that a little bit, Oisin, in a second when we talk about building wealth for the future. But yes, essentially, if you earn 75,000 euros, say, in profit in a year as a sole trader, then you'll pay tax on that profit. If you earn the same 75,000 euros in a company and take all of that out in salary, you'll pay the exact same amount of income tax. Where it can be beneficial is if you're happy to live and exist on a salary of 75,000 euro and maybe you've invoiced 100,000 euro, that's where it can be beneficial. And I will come into that in a little bit more detail in a couple of slides because it's a good question. Anything else there have I missed? Selling the goodwill of a business to your new limited company, not a lot of people know. Yeah, that's true, Francis. I mean, goodwill is much harder to value these days. And when you're the business, there's a lot of paperwork to be done. Can it be done? Yes, it can. It's tricky. It can be tricky. The revenue really clamped down on that a good number of years ago, especially around a lot of doctors were doing that. Incorporating their GP practices, and it changed the rules for a lot of people because there was some aggressive, should we say, tax planning done at the time.
Yeah, I would have done it. I would have done it about 15 years ago when I went from a sole trader to a limited company. But it was a huge saving over about 4 or 5 years
Yeah.
of gradually selling that goodwill back. And it's something that I tell people about when they're thinking of going from a sole trader to a limited company. Another thing that is really important for people who are sole traders who don't really know the benefits is, as a freelancer, you can have a brilliant year or 2 or 3 brilliant years followed by 2 or 3 really bad years. Or you might decide that you want to go and study, or you might want to take time out. And so the idea of having the money in the company, paying the corporation tax, but basically being able to pay yourself the same salary over a period of years and not worrying about, after having a brilliant year, having a really bad year, because that's something that does happen. So
Yeah, it's a really good point. And actually even bring that shorter term, Francis. I mean, we've a number of clients who only work for maybe 8 or 9 months of the year, and they take the summers off because maybe they've got young kids, they want to spend the summers with them. They might earn, I'm trying to keep the math simple for myself now. Let's say 60,000 euro in a year, but they'll only pay themselves 5,000 euros every month. But they're invoicing 8,000 euros for the 8 months they're working. And then they pay themselves a flat 5,000. So they've income smoothing throughout the course of the whole year. So yeah, really good point. Be shorter term, or like that, you can build up a nest egg. So if you're going through a tighter patch, you have funds there to rely on. Absolutely.
Yeah. Yeah,
The goodwill you got in the goodwill at the right time. Got it 15 years ago. Would have been about the time they.
Yeah, but the thing was, because my wife had a different accountant at the time, and her accountant never told her about it, but it was actually a huge saving over
Yeah.
about a 4 year period.
Yeah.
I think you had to pay an initial amount, but it was definitely worth doing.
Absolutely.
Anyway.
It's definitely everything's worth looking at on a case by case basis.
Jimmy,
100%.
Jimmy, we've had a couple of people who have been working overseas over the last year or two, and some of them have come back. Some of them are still working overseas, even though they're, I don't know, tax resident in Ireland. I'm not sure exactly what in every circumstance, but what's the implications in that situation where you have somebody
Yeah,
who's working in Spain for a couple of months, or even in the UK, and they're on maybe in Ireland for 9 months earning revenue here.
yeah. So it varies slightly depending on which country you're in, because you have to look at wherever the work is based, the worker is based as well. But essentially, if I take a limited company structure, because essentially, if I get that right, you pay income tax where the worker is sitting. Okay. Yeah. So if I operate through Jimmy's Company Limited, and I'm sitting in Dublin and I'm invoicing in Dublin, I'm paying income tax to the Irish Revenue Commissioners. But if I go and sit in Spain, or actually even if I go and sit in Uri, and I'm in a different tax jurisdiction all the time, the work is being done in Uri, then I become UK tax resident. I'm not even going to try and explain everything on this call, because again, it's how long have you been there for? Is it, there's different reliefs. If you're going overseas for a period of time and it's for a certain reason, there's a type of relief due. If you're relocating, then your business might be required to register as an employer in the country where you're now sitting. If you're only doing it for a year, then you still need to do that, but maybe you don't need to pay national insurance in the country you're sitting in. You continue to pay national insurance here in Ireland, but that has to be applied for. So it's not just as easy, and people always get mixed up with this whole 183-day rule.
Yes.
But that's about you becoming tax resident potentially in another tax jurisdiction.
Yeah.
Once you're working outside of a country for more than 30 days in some cases, or 60 days in other cases, you now have to pay income tax in the tax jurisdiction where you're sitting. So I would say to people, get the right advice, because it's going to be like, there's no kind of cheat sheet. You kind of go, well, if this and this, then this.
Yes.
It really is like, where are you? How long have you been there? Where were you before that? Where have you been for the last 2 years? Where do you plan to go after that? It gets quite complicated.
Okay. All right. I'm just conscious again, I'm eating into your time, but you've
That's
probably
okay.
yeah.
Are there other questions I've missed? Are we okay?
So I think you've covered everything there that's in the chat box anyway. Yeah.
Cool. I will try and share screen again. Is that back up?
Yeah.
There we go. Okay. So I'm going to look at 4 ways that you can take larger sums of money over your lifetime, tax-free or almost tax-free, or lower tax. These are longer term plays, but they're well worth considering. And I'll caveat all of them by saying they need to be planned to ensure they're the most tax efficient for you. And again, while tax rules are often very black and white, everything is on a case by case basis. So what might be a yes for one person might be a let's look a little bit deeper into that for another. Our job is to make sure, and your accountant's job is to make sure that the right plan is built for you and your circumstances and your longer term goals. So the first up is pensions. And for me, it's the easiest way to save tax. It's hard for us to get excited about pensions, especially in a world where now we're so used to everything on demand. Pension is a slow burn, but if you just look at the figures on screen, you know, depending on the value of your pension, you could get up to 200,000 euros tax-free retirement. Tax-free, that's already 100 grand saved in tax straight away. The next 300 grand of your pension could be at 20%. You would probably have been paying the higher rate of tax if you're putting that much money into your pension. And if you're taking that through payroll, the tax saving could be anywhere between another 60 and 90 something thousand. Tax benefit is substantial, whether you're a sole trader or you're your own company. Although as a sole trader, you are restricted by how much you can put into your pension based on how much you earn. So there's an upper limit of 115,000 euro as your salary, and then it's based on your percentage as age. So in your 40s, it's 25%, in your 50s, it's 30%, and there's a whole bracket up and down the age range. The other thing about using a company to pay into your pension is you get an extra 120 euros for every 1,000 euros you put in, because as a sole trader, when you make a pension contribution, you get 40% tax relief. You get the income tax relief back. But if the company pays, if you pay, let's say, if you have 1,000 euro in profit, and then you put 1,000 euro into your pension, you get the tax relief of 400 euro. But with a company, they're not paying USC and they're not paying PRSI. So all of the money would go in to the pension pot. So it's another thing to be aware of. So that's pensions. One then is kind of saving for a rainy day or a big life event. Like everyone is a big life event. It's different. For some people, it might be something important like a deposit for buying a home. Maybe that's something you've already done or you're going through. Just a reminder, though, that we do have a mortgage business called Mortgage Navigators, and we specialize in getting mortgages for the self-employed. If you're interested in that space, just pop onto contractingplus.com and go to our mortgages page and get more information. But a way of saving money for the future, I mentioned earlier on, and it was Oisin's question, when you operate as a sole trader, you pay 52% tax on your profits regardless of whether or not you spend it. So in a limited company, let's say you have profits of, we used a figure of 100,000 euro, and you only need the 75,000 euros to meet your living costs and your pension needs. That means there's 25,000 euros left over. So as a sole trader, you're going to pay tax on that 25,000 euro, and you'll be left with, let's call it 12,000 euro. And you can put that in a bank account. However, if you leave the money in the company, you'll only pay tax, corporation tax of just under 5,000. That includes, if people are going to say, what about closed company surcharge? I've included that figure in the 5K, which leaves 20,000 euros in the bank account. If you don't know what closed company surcharge is, don't worry about that. You don't need to know, but I've thought about it for the calculations. But essentially, there's 20,000 euros in your company bank account rather than 12,000 euros in your personal bank account. So 8,000 more. Over 5 years, that's 40,000 euros. 10 years, 80,000 euros, and so on. Now, if you look at photos of where you were 5 years ago, you know, it puts a smile on your face and you kind of go, geez, that time has just flown by. Time moves quickly, you know, but actually the 40K in your bank account, that's going to give you a smile as well, that you didn't have 5 years ago. So you might have expenses now and you go, how am I going to put that money where I need all that money? But in a number of years, maybe you have kids that all be finished education. You know, you might, that stage, have your mortgage paid off. You know, be at a point in your life where your earnings are either the same or maybe even higher, but your outgoings will be substantially less. And if you're going to get there, you're there already. This is a great option for you. So, to get the money out of the company, then tax free, to get that 40,000 in 5 years or 80,000 in 10 years or whatever the figure is, you just liquidate the company. Now, there's tax planning around this. You can't just decide, I'm going to liquidate my company and take whatever's in the bank account. There is tax planning around it. But the right plan, you could get that 40 or 80,000 euros tax free. It's under a leaf that's called retirement relief. But the best thing is it's a lot more than 40 or 80,000. It's up to 750,000 euros. And actually, you don't even have to retire. So the 750,000 euros is a lifetime value. Now, starting today from scratch with no money in the account, you're going, well, hell, that's just a pipe dream. But 25k saved a year, so 25,000 euros a year is 1,000 euros less out of your pocket every month. That's a lot of money. All right, I'm not suggesting it's not. But if you're, I don't know, 45 or 50 today, then in 20 years' time, you could be looking at, you were able to do that 1,000 euros a month. You'd be looking at €500,000. But when you get into your 60s maybe, and the kids are growing up and the mortgage is paid off, and there's no more college fees and all that kind of stuff's done, and you're still earning the same amount of money, your outgoings are substantially less, and maybe you can pile a lot more money into the company bank account. Couple of things to add is the 750k is an individual limit. So if your spouse is a director and shareholder of your company, they too can possibly avail of the 750,000 euros. So like if you're a high earner, you're both operating through the same company, then the joint possible limit of cash in the bank that you get tax free is 1.5 million. The retirement relief is available between the ages of 55 and 65, and after 65 it's still there, but the individual limit drops down to 500,000, only 500,000 each. It's still a chunk of money. As I said, after availing retirement relief, you don't necessarily need to retire for the rest of your life, but you do need a good tax plan to put this in place. You need to take action now. And again, as people, we're living on demand. We find it really hard to take action today for a plan we won't see the benefit of for 10 or 20 or 30 years. But I always, in these scenarios, I try and ask myself, what conversation would my future self have with me if they came back and meet me today and said, hey, you just lost out on a big chunk of money because you didn't spend some time thinking about the future today. So worth thinking about retirement relief. And then entrepreneurs relief is separate again. So hopefully this is the last slide. Everyone's still awake. It allows you to sell your business for a value of up to 1 million, and the CGT rate, the capital gains tax rate, will be just 10% rather than the current 33%. Again, it's a personal relief, so if there are 2 or more people involved in your business, then each person can avail of the limit of 1 million. So, I mean, if you're someone who's in a lucky position that over the years you've built up a business that could be sold on in the future, then you could, in theory, generate cash over the next number of years and avail of retirement relief by taking cash out of the company. And if you're left with a brand or a client list that someone would pay you for, then using the entrepreneur's relief, you could minimize your tax further. So that's it. That's I hope there's something useful in there for everybody. Regular post tax tips on our socials. I'm sure. Make sure you're following the indie list if you're not already, but also follow Contracting Plus. And if you're looking out for me on LinkedIn, I'm just under Jimmy Sheehan. Nice and simple.
Jimmy, that's great. Thank you again. That's brilliant. Yeah. And again, in same vein as your previous ones, always something really interesting even for people who've seen it before. There's a really good question there from James Dunny, and it was one that was on my head, given that you've been talking all the way through of the difference between sole trader and the benefits of setting up a limited company. I know when I was sole trader for a long time, the thoughts of kind of setting up a limited company just didn't bear thinking about, to be honest. It just always seemed to be a burden.
Yeah, and look, that seems to be, and actually, when you ask anyone the question, why is that? Nobody knows. They're like, well, actually, I don't know, because it's not that it is a burden, it's just that you don't know what's involved.
Sure.
I mean, it's easy to go and make a toasted cheese sandwich. You know how to do that, but you go, setting up a limited company is really easy. I mean, we set up limited companies, hundreds of them every year. And you can have a limited company set up in about 5 days. It takes a little bit longer to open the bank account with the banks, unfortunately, but the limited company is no hassle at all in setting up. I see James's question there about how much you need to earn.
Yeah.
Again, people focus on earnings and you don't move to a limited company until you're earning, like you could be earning 20 grand a year. That could be your maximum invoice value. And a limited company might make sense for you because maybe it's a side hustle. And as an employee, you could be earning 100 grand a year. You're saying, well, I'm leaving that 20 grand in the company. I'm letting that build up and up and up over time. I'm not touching money for it. Or you could be someone who's, you know, currently earning 60, 70, 80, 90,000 euros a year. And you're operating as a sole trader, and you're going to go, well, even if I move to a limited company, whatever money I'm earning now, I'd still want to earn that. I'm operating at my lifestyle limit. You know, there's nothing more I can save. But actually, maybe your pension would thank you because it'd be more tax efficient to do it through your pension. Or maybe it's better and it's easier to get insurances if, as Una mentioned, you're going for tenders. Or maybe it's just easier because it's just totally separates you and your business. So it's not an earnings piece. There's no trigger point that says at this amount of earnings you need to move from one to the other. It's about looking at a tax plan. It's about saying, you know, you're going to buy a bike. Well, through a company, you can do the bike to work scheme. Are you going to walk away from 520 euros a year in the voucher, the small benefit scheme? You can't do that as a sole trader. You can as a limited company. So, you know, and even if you're only putting 1,000 euros away every year, maybe if it's literally that small, but if you've 20 years left working, there's still 20 grand there in a bank account at the end that is way more tax efficient to have in a limited company when you're closing down and shutting up shop than it would be to have as a sole trader. So there's no one big thing. It's always all the little things all the time.
Very good. Okay. There's a question there from Logan. I'm not sure if you can see Logan's question.
You might just
Can the same limited company set up under a specific NACE code, that's to branch out and start doing a business function not related to the original NACE code?
Yes, yeah. Like the NACE codes typically they're not as important to set up a company. They're more for the setting up the business registration names. But yeah, when we're setting up companies, we use quite a vanilla, quite a broad constitution. So I mean, you could start selling. You could open a sweet shop tomorrow, and then next week be doing graphic design, and the week after that be doing, you know, consultancy work. So yeah, there's no restrictions like that at all. You freelance, or you did I did that one. Is there a guideline on how much? Oh, we did that one. Sorry.
Yeah.
What do people do now in relation to pensions? Are you contributing? No, that's you. That's you.
That was mine. Yeah, and it sounds like, you know, some people do have their pensions in order. I think everybody's advice would be, if you haven't gotten it in order, do it now.
Yeah, and actually a nice comment there from Leslie about, you know, setting up a pension 3 years ago, and she puts in, or he or she puts in a lump sum at the very end of each year. Look, again, that's good. But if you find that every year that your pension lump sum is always around the 10K mark or always around the 30K mark, then I'd say, well, look, if it's always around, say the 10K mark, then put in 500 euro every month and then do your top up at the end. You know, get that money out of the way is the smart thing to do. Because also, you know, your pension works harder for you once the money is in there. Otherwise, it's just sitting in your bank account, not earning any interest. And if you're putting it in at the time that the markets are right, and again, your pension advisor will talk to you about this. It's like, you know, put the money in as the markets are on the way up, and as you get to a certain age, they're going to move, and depending on your risk profile, they're going to move your money away from equities and things that are higher risk and put them into where your money is staying safe for you. So even if you're already doing pensions, but you're doing it once a year, maybe set something up so it's more regular. Again, these are all the things we look at with clients when they do their financial review with Contracting Plus Financial. It's like, okay, do you have a pension? What way are you operating it? Are you getting the best retention? You know, is the fee structure you're on the right fee structure? Because it's very hard for us when we don't know. I mean, I don't even look at the detail. Somebody else does that because they know what that is. I don't know the detail of pensions. You know,
there's a question there from Karen. What's the timeline for using Contracting Plus for an umbrella company with a pre-existing structure?
In terms of the timeline, I mean, you can be set up in less than an hour, and it's a pay-as-you-use service if it's an umbrella structure. So, I mean, it's again, I gave you the number earlier on. Take that down. You know, if it's something you think you might need, give Ian or Kieran a call. They'll ask you a few questions to try and understand the circumstances you're in, and they'll give you the best advice. They'll give you the best advice for you. And even if it's not us, that sometimes is still the best advice. You know, that's important.